Have you heard of how when people win the lottery, they're offered either one lump sum upfront that's lower than the total jackpot they won, or the total amount they've won but paid out over several years? Or something similar kind of happens with mortgages. With an ARM, an adjustable rate mortgage, usually you get offered a lower interest rate, but it's only guaranteed for 5, 7, or up to 10 years, after which you will need to refinance and negotiate a new rate at whatever rate the market is offering at that point. Usually, the shorter the term, the better the rate, because there's a bit of a gamble of where rates are going to be at the point you have to refinance. To the contrary, a fixed rate mortgage is a mortgage at which the rate is fixed for the duration of the whole loan, regardless of what the market does with its rates. Fixed rate mortgages usually go in 15 or 30-year periods and thus tend to be higher because the bank is locking themselves in to the rate for a very long time and they don't know what's going to happen with the economy. Now, when it comes to choosing a mortgage, buyers can always be strategic in choosing an ARM or a fixed rate. Choose an ARM if the rate is low enough and you know this will be a transitory home or a home you'll soon grow out of. Basically, not your forever home. By contrast, choose a fixed rate mortgage when the rate is low enough and your monthly payments are manageable and you're buying a property that you don't see yourself letting go in the foreseeable future. That way you know what your payments are going to be. And if you win the lottery, I don't care which option you choose, just make sure that you buy some real estate and you give me a call.